In this video, we're going to learn how to read Japanese candlestick charts. So if you're going to day trade or use technical analysis, it's important that you learn how to read candlesticks as opposed to line charts. This is an example of a line chart, and I'm using a 3-month chart of the company Twilio. If you just want to see the general trend of a company, this line chart is sufficient. But in order to do technical analysis, you need more data. So this is the same chart of Twilio, but this one displays a candlestick chart as opposed to a line chart. As you can see, it's a bit more complex, but it displays a lot more information. There's only 3 things that you need to understand in order to read a candlestick chart. Number 1 is the candlestick color. Number 2 is the body, and number 3 is the wick. A green candle indicates that the price went up for the day, and a red candle indicates that the price went down. So I want to draw your attention to the first green candle over here. This part of the candle is called the body. The bottom of the body is at $100 and the top is at $104. Because this is a green candle, what this means is that at 9:30 a.m. when the stock market opened, the stock opened at $100, and at 4 o'clock when the market closed, the last price was at $104. So from open to close, it moved from 100 to 104. So that's what the body is. Now let's look at the wick. The wick simply indicates the highest and the lowest price of the day. So on February 1st, the lowest price of the day that the stock traded at was 99, and the highest was 105. So let's recap the movement for February 1st. 9:30 a.m., stock opens at $100. The price went down to 99 and eventually reversed and moved up to a high of 105. And when it closed at 104. So to summarize, each candle shows the open, the close, the high, and the low price of the day. Let's look at the next red candle on February 2nd. So you might be asking yourself, why is the opening price different from the previous day's closing price? Shouldn't it resume the previous day's close? And the answer is, it rarely does. After the market closes, there's still some news that's coming out, and that affects the next day's price. So here's an example. Imagine that after the market closed, the company announces that they're going to close this huge deal and sales are going to go up 30% overnight. Do you think that any shareholder wants to sell the stock at the same closing price as the previous day? Well, of course not. Sellers will be asking for a much higher price. These are called gaps, and you'll often see them in candlestick charts. Gaps aren't displayed on a line chart, and it's important to be aware of gaps because they help you forecast the future price of the stock. And in a future video, I plan on covering gaps in depth, but the important thing to take away from candlesticks are open, close, high, and low. This is the basis of all technical analysis, and this will lay the foundation for all the future videos. So I hope you enjoyed it. Thanks for watching, and I'll see you in the next video.